Hey guys, I thought I'll put out an update on what I think where the markets are headed right now. And as you know, markets have been ripping like crazy since like 4 months now, right? But there are signs of divergence showing up everywhere. Now, divergence is a condition, it's not an indicator. So just because signs of divergence are out there doesn't mean that markets will drop tomorrow, but it's something to be aware of. So how you can use divergence is, if you're bullish on the market and you're making money, it's great, but it's maybe time to dial down on your bullish trades or maybe start registering some profits. To start with, let's look at a chart of SPY. Now I've removed most of the indicators that I commonly use for trading purposes because I'm trying to look at a high level view of the markets. I do have RSI at the bottom, and as must be very obvious to you by now that since uh, November 15th, the markets have been overbought. But overbought doesn't mean that markets will pull back. It's just a condition to be aware of. And from November 15th, markets have just been going up and staying overbought. Anytime markets have pulled back, something has happened which causes markets to reverse course instantly, and that is the situation we have in front of us right now. For example, uh, around February 1st, February seasonally being a weak month, the beginning of February we saw a massive red candle on SPY, but then Meta came out with blowout earnings and the markets reversed course. Same thing happened with NVDA later in February. So markets were beginning to pull back, and then NVIDIA comes out with crazy blowout earnings, causing a huge gap up, and the markets have gone up again. Now, to demystify this chart, let me quickly walk you through what all you are seeing in front of you. So the three dashed lines are moving averages: 8-day blue line, 21-day yellow, and 34-day the pink line. Now this is many traders use moving average crossovers for making trading decisions. So, and I find them very helpful every now and then too. I don't use them on a daily basis, but in this case, if you look at SPY, you will see that the blue or 8-day moving average crossed over 21-day and then finally crossed over the 34-day, which is basically can be used as a bullish signal. And as long as that the 8-day EMA stays above the 21-day, one would want to stay bullish. Now, of course, trading is not as clear cut as this always. Trading is a very nuanced skill, and in this case, it does appear that from from November till now, one should have stayed bullish. But if you go back in the past, you'll find that the signals are not always that clear. But in the current scenario, what I'm trying to point out today is how high can these markets go, and when should one prepare to take bearish trades, go heavy on bearish trades. I have been bearish for the last several months, but the markets have been going against me. So what I've done is I've drastically cut down my trading volume to like 10% of my portfolio. And you need to do that because you will not get direction right every single time. So when things go against you, you just need to cut down on your trading volume and then ramp up that trading volume when things start going in your favor again. So right now what's happening is, let me first show you these lines that you are seeing, the blue lines. Since January, I've been talking about how high can these markets go, because it's very obvious that the markets are going up, but everyone is wondering how high can these go. And you can use something called, there are tools available for you to make these projections. One such tool is called Fibonacci extensions, which is what I have used here. And I had predicted that SPY will most likely go to 500 back in January, and that is one point where it might pull back. And then when NVDA earnings were about to be announced, I did mention a few days before that if NVIDIA hits it out of the park, then this 500 resistance will be gone. And the next thing we'll be looking for is 508 and 520 area. This is that area where the next pullback can happen. And so today we are exactly at that area. We are between 508 and 520. And all the earnings are behind us. That means there is no earnings surprise which can suddenly move the markets. The only thing that could be a surprise is Jay Powell's testimony tomorrow. If he comes under political pressure and paints a rosy picture about inflation, markets can always reverse course, and we don't know what's going to happen next. But based on what I'm seeing today, it looks like this is that area where markets could reverse course. Now, if you are interested in taking bearish trades, what I would recommend is, there is a reason I put these EMAs for you. So one good way of playing safe on direction is wait for EMAs to cross over. So you can see from 11:15 that the 8-day EMA has been consistently above the 21-day EMA. It hasn't dropped below that even once. So one place could be you wait for the 8-day EMA, the blue line, to cross below the yellow line, and that is when you could start entertaining some bearish trades. And then if those bearish trades start going in your favor, then you ramp up your trading volume. Now let's talk about some signs of divergence that I've been seeing in the markets since January 1st. Now, before I proceed, just because you are seeing signs of divergence doesn't mean that markets will change course immediately. It's just something to be aware of. So divergence is a condition, not an indicator. So when divergence starts showing up in the markets, what I would recommend is just start getting cautious. So if you are a bull and you're making good money on this 4-month rally, it's time to drop your exposure, start registering some profits, because a correction is around the corner. We just don't know when it's going to happen. So the signs that I'm seeing here is, let's start with 10-year Treasury yields. So as you know, Treasury yields go opposite to the equity markets. So when Treasury yields are going up, the markets usually fall. So since January 1st, Treasury yields have been going up, and then we had one or two pullbacks. But overall, if you look at the trend is up. So that's one. The second thing is US dollar index, DXY. Same thing we are seeing in DXY. DXY has been consistently going up since January 1st, but yet the markets are also going up. So this is another sign of divergence. Now, divergence always ends up resolving itself. It just doesn't happen overnight. You will start seeing warning signals appear way before things actually happen. So that's why I'm pointing out these two signals for you. Another thing is bonds. So the bond market is usually inversely correlated to the stock market in a low interest rate environment. But in a high interest rate environment, bonds and stocks go hand in hand. Now, the bond market has also been selling off since January 1st. It's on a steady downtrend with some spikes here and there, but overall it's a downtrend. Yet the stock market is going up. So that's another sign of divergence. The only thing that is tricky, which hasn't happened yet, is VIX. VIX has been crushed to like multi-year lows for months now. And although you will see some spikes in VIX every now and then, but overall you will see that we are at 13. So unless we go above 15 and stay there for some time, we are not getting any correction. So that is one thing that hasn't confirmed. Everything else, DXY, bonds, treasury yields are confirming that there is a correction about to happen. But the last clue, which is VIX, hasn't confirmed yet. So I'm watching for that 15 level, and I would imagine that once VIX crosses 15 and stays above there, that will coincide with the moving averages I was showing you earlier, where the SPY, the 8-day EMA will finally start crossing below the 21-day EMA. And that will be the start of our correction. And the final thing I want to point out is the FANGs or the MAG 7. The tech stocks, the trillion-dollar companies which have been driving this AI craze. So I'm seeing signs of divergence happening here as well. So for example, NVDA has gone berserk. As NVIDIA has become unstoppable and all it knows is how to go up. However, there are cracks appearing in the tech armor, and you can see that starting with Apple. NVIDIA is going up, but Apple has been consistently going down. I think it's gone down like 11% this year. That's number one. Amazon is just beginning to pull back, but nothing spectacular here. Microsoft is beginning to pull back. Let's look at the rest of the MAG 7. Okay, so start with Meta. Okay. Meta is kind of behaving like Nvidia because they had really good earnings. So it has been going up. Netflix, same, good earnings, going up. Google is behaving like Apple. It's been going down. Tesla is dropping too. So there are cracks appearing in the tech armor. So just be aware that, this entire rally was fueled by tech. And 4 of the MAG 7 stocks are beginning to drop. It's just a matter of time that everything else gets pulled down. I hope that gives you an insight on what kind of signs I'm looking for. And I plan to do these videos every Tuesday. So subscribe to the channel, and if you're interested, you'll get notified on Tuesdays when I put out these videos. My overall guess is that we have been standing on the edge of a cliff for like months now, and it might be time for the markets to go into a correction. And correction is not a bad thing. Things cannot go up in a vertical line, so you do need correction. Corrections are healthy, and in fact, although I've been bearish for a few months, I've been waiting for a correction so I can go bullish, but I just haven't got any opportunity yet. So I'm actually looking forward to a correction so I can make money while markets are falling by taking bearish positions, and then I'm ready to go bullish.